The Fed is holding interest rates steady, but your wallet could still feel the impact. So this morning, Jeff Anthony with Wilde Wealth Management is going to be breaking down what this means for your wallet. So, we always hear about the Fed and this anticipation of what they're going to do, if it's going to go up, if it's going to go down. So it's holding steady at this point. So break that down. What does this mean for the consumer?
Oh, yeah, absolutely. Well, and Justin, thanks for having me on.
For sure.
So the big thing with keeping rates the same right now, so if you have any adjustable debts or anything like that, credit cards, auto loans, things of that nature, we're not going to get any reprieve right now. So I would anticipate that we're going to continue to have that for a little bit longer until they meet the next time. The other side of the coin, though, is if you're on the savings side of it, you're still getting decent rates on your savings accounts and CDs.
So what does this mean for like a home buyer as well? And here's how this is affecting your wallet, your credit card interest rates, your loan payments, your savings earnings. I mean, so there's a lot, but mortgage rates and home affordability. A lot of people, they want to buy a home. They want to get out of a renting situation. I mean, do you buy now? Do you wait? Do you wait for those rates to go lower?
Yeah, so it's a great question. We get it a lot from our clients. One of the biggest things that we do is you really got to hone in on your financial goals and what you can afford. We typically use about 25% of your net take-home pay should cover your living costs. So as far as your mortgage, your insurance, things like that. And so just staying very disciplined in that. And I know it makes it hard because obviously rates are quite a bit higher. So
yeah, I guess what are you, as far as them changing the rates, I mean, how could that change your payment drastically, just a little bit?
Oh, significantly, yeah. So I mean, if you look at it from a few years ago, like a lot of people are fortunate enough where they have rates under 4%.
Yeah.
Now they're probably hanging out somewhere around 6.5. I mean, the payments have doubled.
Right,
so,
right.
Yeah.
Well, it also, because I was lucky and got in on the lower rate, but now it's just like, well, now what do I do?
Yeah. Now I'm stuck. No.
You do. You feel you feel stuck a little bit.
And the biggest thing right now, and this is kind of the conundrum that we're in, you have people that think that their houses are worth X, and they have buyers at Y, and with rates being as high as they are, it's like, well, does the payment justify the actual house that I'm getting anymore? And I think that's the difficult piece. So buyers and sellers are kind of in this like battle right now.
And so they're meeting, you said the Feds are meeting every month at this point. So they're meeting next month. What, I guess, in the business, what are you guys expecting?
Yeah.
What's the word?
So the forecast of the Federal Open Market Committee is the one. They're the 13 individuals that they'll meet together to set what the rates are going to be. They're anticipating that we could potentially have one more rate increase by 0.25% by the end of the year. They've been very vague. We got the new Fed chairman, and he's a big proponent of kind of keeping everything quiet. So we're not getting as much forward guidance as we used to. But yeah, we do think that they'll probably either stay the same, slightly go up, but it's going to be impacted by so many different variable things like jobs, inflation, all those other things. So.
What does that mean for debt? Because also people nowadays are carrying a lot of debt as well.
Yeah. So the biggest thing that you can do is take a look, kind of look at all your finances together. Make sure that if you have any high debt, like on credit cards, they're usually in the high teens to low 20s. Try to get those paid down as quick as possible and really just focus on that. And then on the other side of it too, make sure you got a healthy emergency fund in the event that something comes up.
What if you have that high debt though? Are you trying to pay down the high debt and build the emergency fund?
I think you do both. Yeah, so you want to make sure that you have it on a time schedule. So let's say maybe you can get it paid off in the next couple years, but you be very disciplined for that, because if you're making the minimum payment only, I think it takes you like 18 years or something like that to get it paid off, which is insane.
Oh my goodness, 18 years. Well, I guess if it feels like it's not going down, I guess it's not going down. Any last minute advice that you have for anybody that's just trying to be financially responsible and get back on track?
Yeah, so I would say just put a plan together, get a budget, really try to live inside your means. Right now it's difficult because I know that things are costly, but just making sure that you do at least once a year a financial review and just kind of look at everything and saying, where's my money going? Is there things that I can change to help improve myself? For that way, in the next 5 years, 10 years, I'm going to be in a better spot. So it's all about starting today.
Yeah, it really does make a difference. When you write down all your expenses, you're like, wow, I had no idea. Those streaming services, boy, those add up fast.
They do.
Jeff, thank you so much.
Thanks, Justin.
Good stuff.